Before we get on with today's podcast, here's a special announcement for our podcast listeners. From time to time, you hear Steve Peasley talking about portfolio checkups in locations in the San Francisco Bay Area, Los Angeles, and Orange County, and that kind of leaves you out if you live in Orange County, Florida. Well, don't feel left out. If you would like to take Steve up on his offer to look over your portfolio and give you a health scan, it can be done on the phone. You can send copies of your documents by fax, email, or regular mail and join Steve for a one-on-one conference call. If you're interested, just go to investtalk.com or call our 24-hour InvestTalk answer line at 888-99-CHART. That's 888-992-4278. And thanks for listening to Invest Talk. For the next hour, the discussion is about making the most of the money meant for your retirement. This is Invest Talk, made possible today and every day by Klein Pavlis Peasley Financial. KPP is a professional money management firm dedicated to minimizing risk and maximizing opportunities for profit. Now, KPP President, Registered Investment Advisor Steve Peasley.
Good afternoon, everybody. Welcome to this edition of Invest Talk. It's a daily program all about talking about, we discuss investments, stock market investments, stocks, bonds. We'll talk about anything that deals with money. We invite you to call in. This is a call-in show. Now, we invest these few minutes in your retirement planning. And, everybody is working toward retirement. Now, again, I stress, that doesn't mean you're going to quit working and not do anything. It means that you're going to quit doing what you have to do and do what you want to do. And that's the key. We work toward that. That means you got to make the most of the money you already have earned and let it start working for you. That goal, of course, is to be financially independent by the time you want to retire. Now, we are still being true to those core principles and our belief that the very market that let us down with a thud, by the way, I know how painful it's been, but that market will also carry you back up. In this next cycle, there's always cycles, everybody, up and down cycles, and we're in a big down cycle. We have been in a big down cycle. There's always another up cycle. You need to take advantage of this next up big cycle, and I think the next big cycle is going to be big, huge, a big up cycle. But first, we have to deal with the mess we got ourselves in. Now, despite all the hand-wringing, to the contrary, almost all the perpetrators in this financial crisis we've been dealing with acted logically. What do I mean? I'm telling you, everybody, you can blame everybody down the line, from the person who's borrowing the money, for the house they can't afford, to the person making the loan, to the banks, to the commercial banks that package those up, to everybody to the people who rated those things as high quality. Everybody in that line acted very logically. Now, that's going to be a talking point. We have an article on investtalk.com. That's the conclusion that they came to, and it makes perfect sense, and I'm going to explain it. Think about it. What about the people who bought houses that they really couldn't afford? Did they act logically? Well, think about that. If you don't have a lot of assets to lose, right? You don't have a lot of assets to lose, and someone's willing to give you a low interest, nothing down payment loan, no down payment, to buy a house during a market where the house prices are going up, it makes a lot of sense to take that money, doesn't it? What's your risk? What is your risk? It makes perfect sense. Buy most houses they'll give you a loan for. Buy the biggest, because if it goes up and you sell at the right time, you'll make a fortune. You'll make a killing. If it goes down, what's your risk? You walk away from the loan. You just walk. So you're not taking a risk if you're the guy buying the house that you couldn't afford. Really, you're not. Okay? Now, it's a hedge you win that tells the bank loses, not you. Now, dumb loans made perfect sense for executives at the banks, at the lending institutions, right? Think about what they're doing. They're sitting there in their big offices or big chairs, and they say, how do I get paid? I get big bonuses if the more business I write. I'm going to write more business. I'm going to get huge paydays. Look at all the money these guys have been paid. Huge bonuses based on how many loans, how much money they're turning over, how much money they're bringing in the door, then selling out the door. Redo the loans, more people they attract, more income for the company, the more bonus they get next year or this year. Were they looking for 5 years, 10 years down the road? Heck no. Those people weren't looking long term. They knew that these loans stunk. They knew. Their bankers have been doing this for years and years and years, these executives. They know it's going to happen, but made perfect sense for them to make, millions of dollars in bonuses now. Perfect sense. Short-term performance is what they're looking at. Makes perfect sense. It's all logical. It was stupid, but it was all logical. It worked great as long as property values went up. Now, according to Richard Gibbons of thefool.com, the only stakeholder for whom stupid lending didn't make sense was you and I, shareholders of the stocks of these companies. Now, who's supposed to watch out for our interests? Ours? The board of directors. They're supposed to force management to use smart long-term strategies. Where were they? How come they didn't? Because they're not independent. They're too closely tied to the president and the executives. They don't, they're not the ones who are really looking out for you. They're looking out for their own self-interest, and they're buddies. They're not independent enough. So all the people in this train of woe made perfect sense in their decision making if you're only thinking short term. So how do we as investors get out of this hole? How do we get out? Today we're going to plot a course for you to do something about it. How do we get out of it? Remember, you're not a banker. You can't make the banks perform. You're an investor. What are you going to do? What is the difference between a person who does better than average than the one who suffers most in the stock market? What is that? And it's always the same answer. It's information and time. Now, I can help you with the information. I'd be happy to do that. I like doing that. But you've got to supply the time, and you've got to supply the attention. What made us at KPP Financial get out of all our financial stocks well over a year ago? Why did we get out of all those? Why did we not participate in that financial sector? Don't get me wrong. We lost money in this year because we didn't get conservative enough. I can't, I don't want to, say that we're just geniuses. We're not. Anybody tells you that they didn't get hurt are lying. They're just lying to you. We got hurt. But there's certain things that you can look at and say, wait a minute, that doesn't seem right. And Jerry Klein, my partner, we looked at this and said, you know what? This doesn't make a lot of sense. All this leverage, this is, all these cheap mortgages, it's going to come back and hurt people. Jerry, over a year ago, said this leverage stuff is going to really be bad. How bad? We didn't know. No one really knows. But Jerry called it a long time ago. Something bad is going to happen. And it did. That's what the great thing about Jerry and his experience is helpful for. Now, we don't know how bad. We should have went short, so we should have got more conservative. We went to a lot of cash, but not enough. Those kinds of things. But how do you recognize these things? And we can help you with that. But you got to supply the time to be able to do it.